Tony, what do you think about this volatility for the FOMC? Not just any volatility, but the volatility you see after the release.
Is it higher or lower?
Yes, is it higher or lower? Can we gauge if we're going to see some kind of at least can we estimate the volatility based on something beforehand? Can we look at any volatility index to give us a kind of an estimate of how much volatility there will be?
Honestly, I don't know the answer. I would say it's pretty random, would be my guess, but I don't want to go through down the middle and take that kind of stance. So the obvious view would be that it's lower post FOMC than prior.
Let's take a look. First slide. All right. So for the FOMC report on June 12th, the expected move in the SPX was 48 points plus or minus on the day before the announcement. This was on June 11th taken for the June 12th options. Okay, so on the June 11th, this is live. This was real data. 48 points plus or minus by the close on Wednesday. Okay, so this is taking into account CPI and FOMC. Now, we didn't know this at the time, obviously, but yesterday the S&P was up. What was it? 45 points?
Yeah,
46
and that
points,
was
something like
off
that.
of its highs, right? It was up like 60 some odd at one point.
Yeah, but from open to close.
Yep.
What was the movement?
Yep.
48, 45. So this time they nailed that one. I mean, that was just almost kind of scary in a way. So the question is, if we go to the next slide, since 2020, what was the actual volatility on the day of the FOMC report in terms of S&P points? And is the current expectation as of Tuesday less or greater than how much the S&P tended to move on the FOMC day? So was 48 points high or low? And what was the actual volatility overall since 2020? Just to give people some context and say, okay, if we have this volatility, then we should expect approximately this movement in the S&P, just to give us some stuff to look at, increase our market awareness of this. So we're going to do a study since May of 2020. We're going to record the actual point changes in the SPX on the FOMC days. On the day of the announcement, what was the change in the SPX on average? We also recorded the VIX 1 day the day before the event. Now, the VIX 1 day will tell us volatility, roughly the expected move for the next day options. Okay, so on Tuesday, if you look at it, it closed at about 18. And every single time you have a FOMC report, the VIX 1 day will close a certain number, which essentially is a proxy for the expected move, like we saw on slide 1. Okay, what are the average point changes for the SPX given a level of VIX 1D the night before? So can we use, if we know a FOMC, let's say it's Tuesday night, we know the FOMC is on Wednesday, can we look at the VIX 1D, which is 1 day volatility, to gauge what the expectation will be for tomorrow and what has the actual move been if we saw a certain level of 1 day VIX the night before?
Well, I will say that yesterday's VIX 1 day was elevated with the two numbers coming out yesterday, and today it's down considerably from 11 to 9.
Yeah, you're going to expect that. The VIX 1D is not a tradable index. All it does is give you a rolling, basically data set of tomorrow's expectations.
Yep.
So like if you look, and a lot of people don't understand how the VIX 1D works. They just kind of discount it because it doesn't make sense. It's not tradable. And I get that, but it's not supposed to be a tradable index. It's essentially supposed to be giving us a data set every single day. What is the expected move for the SPX for tomorrow? So let's say you look at the VIX 1 day for June 3rd. That will give you the expected move in the SPX for June 4th. And then the next day on June 4th, it'll give you the expected move for June 5th. It's not really going to tell you much about the broader market. It's just going to tell you about tomorrow's expected move. So on the day of the FOMC report, FOMC, the average SPX change was plus or minus 45 points. So taking all of the reports, the average change was plus or minus 45 points. So that's your baseline. That is your long-term average since 2020. Funny enough, yesterday was literally at the average. So you can see this. I mean, yes, it worked out well. Obviously, it doesn't work out that well all the time, but yesterday did work out to a T. Average VIX 1D the day before. So in other words, on the the night before the FOMC, closed at 24. So that was the average one-day VIX close the night before the FOMC, which is 6 points higher than the VIX 1D close of 18 on June 11th. So yesterday, the VIX 1D actually closed 6 points lower than it usually closes for these events. So it was a below average expectation. When the VIX 1D closed below the average, the SPX tended to only move an average 36 points the next day.
Right.
When the VIX 1D closed above its average, the SPX tended to move almost double, 65 points. So there is actually some predictability in what actually will happen in the move based on what you see in the VIX 1D the night before, which is, and it's quite significant. It's about double. Now, yesterday we had the VX 1D close below average. We got an actual move of 45 points. So it was a little bit greater than this 36 points that we would see if it closed below average, but it's still pretty close, right? And the point here is to say that if you are trading these FOMC report days, it does actually pay. There is some correlation to what the expected move was, whether you look at the VIX 1D or whether you look at the expected move in the options. That does actually correlate to what you're actually going to see tomorrow. Now, it's not going to be literally the expected move all the time. And in this case, it was. If you look at the SPX options, a lot of the time you're going to see a correlation to that, which is cool. It's not expectation does actually match what actually happens, and that's even on these singular binary event days.
It's good. It's good. It's good to know. It's good to know it's accurate, right? It's the best thing that we have.
For anybody trading, the single most important thing you can look at for anything you're trading, whether it be a 45-day trade, an earnings trade, a short-term trade, a one-day trade, binary event for FOMC, whatever it is you're looking at, the volatility gives you the best expectation. It has the highest frequency of telling you what the actual move will be. Even if you have some deviations sometimes, which is, of course, expected, it's the best we have. And a lot of the times, it's actually pretty accurate. And for this study, it's basically verifying that concept for FOMC days, as opposed to our typical 45-day trades.
It would be a wonderful contest to have, instead of like they do on TV and everywhere else, back in the day and even now, where's the market going to close on Barron's, at the end of the year, the middle of the year, where is this going to go? Where's that going to go? Which nobody really knows. Let's prove to everyone that there's no better indicator than implied volatility for an expected move, and have somebody not know what the expected move is, not know what the volatility is, and tell me how much a product is going to move on an earnings event or on any other kind of FOMC meeting news event, or just daily, what's it going to move? There's no better indicator than volatility right now, because it is the market. The market sets the volatility of the product, and it's simple and brilliant.
Right, exactly. And the funny thing is that even though the VIX 1D is not a two-sided market, it does derive from the SPX options in the one-day cycle, right, which are a two-sided market.
That's right.
So you can trade them. You just won't really. You just kind of have to.
You can't trade that number. You have to trade the options itself. Right.
That's right. You have to trade the options specifically, but that number comes from a tradable two-sided market. So it is the best we have.
Right. So if you were trading the one-day options and you looked at the VIX 1D, and you were short premium, and that started going higher, you will notice that your position is losing money. 9 times out of 10. I know time has to go by, everything being linear.
Yes.
I'm just making an example.
Yes, exactly. And again, I like the VIX 1D because it allows people who have never been exposed to maybe options or this concept of expected move to just be able to look at it and say, oh, what's this one single number? Well, this number represents how high or low tomorrow's expected move is. And that, I think, makes it easier for people to digest as opposed to explaining to them, okay, look at these SPX options and then look at this number, and this number basically tells you like the straddle is like the, you know, trying to explain the expected move. It's a good way to get introduced to expected moves, which is why I like the index, but obviously it's priced off of the thing we always use. So it's essentially one and the same.